Welcome to this explainer. Okay, let's be real for a second. Have you ever looked at the financial world and just felt completely overwhelmed? There are 100 different people on TV or the internet yelling about what you absolutely need to know about investing right now. They throw around complicated charts, bizarre ratios, hot stock tips, and stress over the perfectly timed entry point into the market. Honestly, it can make anyone feel like they just don't have enough money or enough knowledge to even get started. Well, here is a secret that almost nobody on Wall Street wants to say out loud. You can ignore about 90% of that noise, seriously, because building real wealth, it comes down to just three core principles. Get these three things right, and all that complicated stuff barely matters. So today, we're going to tear down that whole illusion of complexity. We're going to give you a simple, reassuring step-by-step guide to securing your financial future, even if you are an absolute beginner. So, do you really need to be a math genius with a massive bank account to build wealth? Absolutely not. No way. I promise you, a lot of this investing stuff feels overwhelming on purpose. I mean, there is a massive industry out there that profits off making it seem incredibly complicated, mostly so you'll feel insecure and just pay them to handle it for you. But the everyday people who quietly build serious wealth over their lifetimes, they aren't glued to multiple computer screens all day. They definitely aren't doing complex calculus. They're just following a few basic principles with relentless, boring consistency. And today, you only need to learn three simple things. Here is our step-by-step roadmap for today. Step 1, plant the tree. Step 2, protect your forest. And Step 3, automate your emotions. That's the whole shebang. We're going to completely demystify this entire process without any confusing jargon. Okay, let's dive into this. Step 1, plant the tree. First off, I want you to slightly change how you think about saving money. Don't think of it as locking your cash away in a dark bank vault. Instead, think of investing your first few dollars as planting a tiny little seed in the ground for long-term growth. That seed grows through what is honestly the ultimate wealth-building engine, compounding. Compounding simply means your money earns a return, and then those returns start earning their own returns. It's exactly like our tree. The trunk grows branches, right? Then those branches grow their own branches, and then those grow leaves. Now, early on, the numbers are going to look tiny, but give it enough time and something absolutely magical happens. And here is a hugely empowering fact, especially if you feel like you really don't have much spare cash to invest right now. Because of how compounding works, time actually matters so much more than the sheer amount of money you invest. For real, someone who starts early, say in their 20s, with a tiny amount of money, like literally just $20 a month, and just lets it sit there, can easily end up way ahead of someone who starts in their 40s with a massive chunk of cash. And it's not because that younger person was some sort of financial wizard, it's simply because they gave compounding more time to work its magic. When you compare these strategies side by side over a few decades, the difference is honestly staggering. Regular cash savings, like the stuff hidden away in a basic checking account, just moves in a flat, straight line. It's basically doing nothing. But exponential compound growth, it doesn't move in a straight line at all. It actually curves upward, faster and faster the longer you leave it alone. The branches are literally multiplying. Now, you might be wondering, what kind of growth are we actually talking about here? Well, historically speaking, a broad stock market index has returned somewhere around 7% a year on average after inflation over the long run. Now, obviously, that's not a guarantee, and no single year actually looks exactly like a perfect 7%. I mean, some years the market is way up, and some years it's down. But over decades, that steady 7% growth, just constantly compounding on itself, is exactly what quietly turns modest, tiny amounts of money into serious, life-changing wealth. But here is the catch. Compounding only works if your money actually survives long enough to grow. So what happens to your wealth if you bet absolutely everything you have on just one single company, one single tree, and it unexpectedly gets struck by lightning? If that one company gets sued or disrupted by new tech or just straight up fails, your entire life savings gets wiped out. Decades of compounding just gone overnight. No thanks. Which brings us to step 2, protect your forest. To make sure a single random lightning strike doesn't totally ruin your financial future, we use something called diversification. It is literally the ultimate protective shield for your money. Think of it this way. If compounding is the powerful engine of your wealth, diversification is the vital safety mechanism that keeps the whole engine from blowing up. It's often called the only free lunch in investing because it significantly lowers your risk of losing everything without lowering your expected long-term return. And listen, you do not need to be a Wall Street expert to diversify. The absolute simplest, most powerful tool for regular, everyday people to do this is called a low-cost index fund.
Demystifying this is actually super easy with our analogy. Instead of planting one single tree and just praying it survives every storm, buying an index fund is like instantly planting a vast, diverse forest. If one tree falls down, the forest still thrives. By purchasing just one single index fund, your money is instantly sliced up and spread evenly across hundreds, sometimes even thousands of different companies all at once. You own a tiny little piece of the big tech companies, the grocery stores, the healthcare providers, the whole lot. This incredibly simple tool instantly spreads out your risk. So if one single company completely fails and goes to zero, it's really just a tiny dent in your massive portfolio rather than a total disaster.
So the crucial point here is this. You absolutely do not need to be a stock-picking expert to safely grow your money. Actually, scratch that. Trying to guess which single company is going to be the next big winner is exactly how most beginners lose all their money. Stop trying to find the one winning horse. With an index fund, you just start owning the entire race. All right, moving on to step 3, automate your emotions. So you have the engine and you have the protective shield. But this final principle is often the absolute hardest one to master: discipline. There is a highly uncomfortable truth in the investing world. The average everyday investor actually makes less money than the very funds they are invested in. Just let that sink in for a second. The index fund itself does perfectly fine, but the human being holding it earns less. Why? Because your biggest enemy isn't a bad market. It's human behavior. It's you. Look, we are biologically wired to be terrible at investing. Our emotions tell us to get super excited when the news is great and stock prices are soaring high, so we buy in at the very top out of FOMO. Then the market inevitably takes a dip, sheer fear takes over, and we panic sell at the absolute bottom. We end up buying high and selling low. Because panic and excitement cause people to completely abandon their brilliant plans, we desperately need a system to protect us from ourselves. We need a rock-solid strategy, not emotion. The good news here is that you don't need iron willpower to fix this. You just need to automate your investing. Here are the literal 1, 2, 3 steps to use automation as your psychological shield. Step 1, set up an automated scheduled contribution from your bank account. Honestly, even if it's just a tiny amount every month, set it up. Step 2, let the computer system automatically buy your index funds steadily, completely ignoring whether the market is having a great month or a scary month. And step 3, when the news is screaming about a giant market crash and you feel that desperate, burning urge to react, do nothing. Just let your automated plan run. I know that probably sounds incredibly unglamorous, but discipline isn't supposed to be exciting. It is boring on purpose. Reassure yourself that this boring, unsexy consistency is your actual superpower. Being boring is exactly what allows the compounding engine and the diversification shield to actually do their jobs over the coming decades without you constantly interrupting them. And that brings us to the ultimate wealth foundation. Let's see how this all builds on itself. When we bring all 3 of these together, we create a completely solid, unshakable structure. Compounding is the powerful engine that grows your tiny seeds into a massive forest. Diversification is the protective shield that keeps that engine incredibly safe from sudden disaster. And discipline? Well, discipline is the seatbelt that keeps you firmly in the seat when the ride gets a little bumpy. If you miss even one of these pillars, the whole strategy wobbles. But together, they're virtually unstoppable over time. As we wrap up this explainer, I want to leave you with a question to really reflect on. Sitting still when everything inside you desperately wants to react? Or trusting the math when you feel financially insecure? Which of these 3 principles is the hardest for you to master personally? Is it planting the tree early, trusting the forest, or ignoring your own emotions? Remember, you absolutely do not need to be a Wall Street insider. Mastering these 3 simple basics is all you really need to build real, lasting wealth. Think about your answer, and hey, start building your foundation today.